company lost $47 billion in 18 months. Here is exactly how that happened. We are going to break down every decision that turned the hottest fitness company in America into a symbol of corporate recklessness. The warning signs were visible the entire time. Nobody at the top wanted to see them. Peloton was founded in 2012 by John Foley, a former president of Barnes and Nobl. The concept was straightforward: deliver boutique fitness class energy directly into the home. The bike cost $2,000. The monthly subscription was $39. For years, growth was steady but unspectacular. The core customer was upper middle class, time poor, and willing to pay a premium. Peloton was building a sticky, recurring revenue business with a hardware entry point before that phrase became a Silicon Valley cliché. The community around the product was genuinely passionate. Then the pandemic hit. Gyms across America shut down overnight. Peloton went from luxury product to only option in a matter of weeks. Revenue exploded by 172% in a single fiscal year. The stock price surged from $29 at IPO to a peak of $171 per share within 18 months. By early 2021, Peloton was posting over $1 billion in quarterly revenue. The market cap hit $50 billion. The company had never been more valuable, and that is precisely when the most destructive decisions were made. The financial press called Peloton a generational company. Analysts were publishing price targets of $200, even $300 per share. CEO John Foley was appearing on magazine covers. Inside the company, a dangerous consensus was quietly forming around a single fatal assumption. Management made a fundamental error in reasoning. They looked at 2020 demand, assumed it would not just hold but accelerate, and began making irreversible capital decisions on that premise. This is the trap that ends companies, mistaking a temporary external condition for a permanent structural shift. Here is what was actually happening inside Peloton's executive suite as pandemic demand peaked. The company was spending as if the growth rate of 2020 was the new floor. The numbers that followed tell the story better than any internal memo ever could. In late 2020, Peloton placed enormous component orders betting supply would never catch up with demand. In 2021, they paid $420 million to acquire Precor, a commercial fitness manufacturer, expanding factory capacity aggressively. They signed warehouse leases across the country, locking in enormous fixed costs at exactly the wrong moment. The math broke down almost immediately. Vaccines rolled out through spring 2021. Gyms reopened. Consumers who had spent 14 months inside their homes suddenly wanted to be anywhere else. Peloton was left holding billions of dollars in inventory and manufacturing capacity that nobody needed. The company was warehousing bikes it could not sell, paying for space it could not fill, and absorbing supply chain costs it had locked in at the absolute peak of pandemic demand. Meanwhile, the revenue that was supposed to cover all of it was shrinking every single quarter. Revenue declined. Operating losses exploded. In the fiscal year ending June 2022, Peloton posted operating losses approaching $2 billion. The stock had already shed over 80% of its value from peak. But there was still one more crisis waiting to compound everything. In early 2021, a child died after an incident involving the Peloton Tread Plus treadmill. The Consumer Product Safety Commission issued a public warning and urged consumers to stop using the machine. Peloton initially pushed back, publicly calling the government warning inaccurate and misleading. They recalled 125,000 units weeks later at a cost of $165 million. But the reputational damage was permanent. The recall was not simply a financial charge. It fractured the brand's carefully constructed image of premium quality and safety. For a company whose entire value proposition rested on consumer trust, the damage cut far deeper than the balance sheet. By January 2023, Peloton stock had collapsed from $171 to under $7, a 96% decline. $50 billion in market value had effectively disappeared. The subscriber count, however, had actually grown slightly during the same period, exposing a painful truth. The product worked. The business model built around it did not. This is the part of the Peloton story most analysts overlook. The product was not the problem. Millions of people still loved riding their bikes every morning. This crisis was entirely self-inflicted through financial decisions made at the executive level under conditions of extraordinary optimism. The strategic errors compound when written side by side. Peloton spent $547 million on sales and marketing in fiscal year 2021, aggressively chasing customers at the exact moment demand was turning negative. They were paying to acquire users while unit economics were collapsing beneath them. In January 2022, the board made the decision that had been building for months. John Foley, co-founder and CEO, was pushed out. 8,000 employees, roughly 20% of the global workforce, were laid off in a single announcement. The company that had been the symbol of pandemic prosperity was dismantling itself in public. Barry McCarthy, former CFO of Netflix and Spotify, took over with a single mandate: keep the company alive. He outsourced manufacturing, abandoned the own factory strategy, and pivoted Peloton toward a software and content platform. He made the app free to non-bike owners. The entire strategic identity of the company shifted. The pivot was strategically logical. Peloton's real asset was never the bikes. It was the content library, the instructors with genuine celebrity followings, and a loyal community with high engagement. But an asset-light model only saves you if you survive long enough to reach it. The runway was burning while the transformation was underway. Part of McCarthy's recovery strategy was placing Peloton hardware inside hotels, corporate wellness centers, and residential rental platforms, collecting recurring subscription revenue without shouldering the cost of consumer hardware sales. Access without inventory risk. Peloton leaves 4 hard lessons behind. External tailwinds are not a substitute for a durable business model. Fixed cost expansion should always lag demand confirmation, never lead it. The speed of a crisis response matters as much as the decision itself. And cash reserves are not accounting surplus. They're the options you hold when things go wrong. Peloton was not an isolated case. Zoom, Wayfair, and dozens of other pandemic-era companies made the identical category error. Each built operating structures around demand levels that were by definition impossible to sustain once the conditions creating them disappeared. The market rewarded the spike. It punished the assumption that the spike was the baseline. Against the S&P 500, the divergence is brutal. The broader market recovered and reached new highs across the same period. Peloton never came close to its previous peak. By 2024, Barry McCarthy himself stepped down, citing the continued difficulty of the turnaround. The company entered its third strategic identity, still searching for a stable foundation. Put the 5 decisions together, and a single pattern becomes unmistakable. Every capital allocation, every acquisition, every hiring decision, every warehouse lease was built on a model in which 2020 demand never stopped growing. Nobody in the room asked what happens if it does. That question, never asked, cost the company $50 billion. The most dangerous moment in any business is not when things are going badly. It is when things are going so well that leadership cannot imagine them going any other direction. Peloton believed its own story completely. That is the oldest and most expensive mistake in the history of business. Peloton still exists. It still has millions of loyal subscribers riding their bikes every morning before the rest of the world wakes up. Whether it ever recovers as a business, not just as a product people love, remains the open question. The bikes outlasted the empire built around them.